there's so much that people don't understand that think they do. And all of a sudden, knock on wood, someone passes or something happens. And all of a sudden you have all this tax burden. You have this, And it's like, oh, well, you could have done X, Y, Z. It's too late when it's too late.
Yep.
Like that is the problem that people make. You need to be in front of this from the start, dealing with Andy from the beginning so that everything is done. Like a lot of people don't understand. Hey, listen, you have 4 or 5 mortgages that are out there. Are you properly insured? So when you die, this insurance pays your mortgages and your partner is receiving the benefit of these rents and they don't have to take on the burden of these mortgages. I mean, as simple as that is, you don't think about that. You think about that, and that's what your job is. And I think that's incredibly important for people to understand that the minute you understand that you don't understand, things will be better for you.
Right.
What's the 5 Ps? Do you remember it?
Proper preparation prevents poor performance.
There you go. It doesn't matter how much money we get. If we don't close, it's no money, right? So no close is no money. I'm everything that I am because of my dad's death. And I wouldn't be as successful without his death. Hey, it's Jason Stratton with the Jason Theory, and I'm here with Andrew Embery, who has more designations than royalty, that's been married to 17 different people from 17 different countries. So we'll go over his designations, but he does have a couple words before we start, so you don't sue either of us. Please give us your words of wisdom.
Yes, thank you. So the topics we're going to talk about today are relatively complex. This is not financial advice. Before making any financial decisions, please consult your tax professional, legal professional, and financial advisor.
We should just end on that.
Yes.
All right. So what we're going to get into today, which is really interesting, is what exactly a financial planner is and why you need one, and a lot of things that people don't understand that people like Andy do. And it's basically from the start of your life to your death, people like Andy, Andrew, people not like, there's not a lot of people as good as Andy, but what he does is basically set your family at ease from everything that could happen, from catastrophes, from insurance to investments to playing defense, and basically making your life easier. And at the same time, mitigating, which we all want to do, is paying taxes in Uncle Sam. So you kind of have like a 3-stage, like a pillar. Yeah. So let's go over that. We'll deep dive into the second pillar, which I think is people really don't understand. Yeah. But let's talk about, first off, let's talk about your designations. So let's puff your chest here for a second, since you've gone to school, after school, a gazillion times.
Yeah. So I am a certified financial planner. I am a chartered alternative investment advisor. I'm a certified private wealth advisor, certified exit planning advisor, as well as a chartered retirement planning counselor. And this morning I just found out that I got named to the 2023 Best in State Illinois Advisor list. So
there you go. So we're hearing it from someone that knows what the hell they're talking about.
Yeah.
And let's start off at your pillars that we talked about, like pregame.
Yeah. So, look, if you come and you sit down with a wealth manager like me and you ask them what they do, you're going to get about 27 superlatives. They're going to rattle through them, and you're not going to be any closer to really kind of knowing what it is that they do. And most of them are going to be pretty investment focused. My wife and I have developed what we call the wealth management formula. We define wealth management plus investment consulting plus advanced planning plus relationship management. So, and I'll break down those 3 pillars to you. So the first pillar is investment consulting, and this is obviously how we get paid. But the reality is, and I think that we're really good at the investment consulting side of it, so I don't want to downplay that. But honestly, anybody who's been in capital markets for an extended period of time should be able to do a pretty good job at that. And we don't believe that that's where you're getting the real value out of a relationship with somebody like me or my wife and I. So the second pillar is advanced planning, and this is composed of 4 sub-pillars. Wealth enhancement, so this is working with your tax advisor as well as your lending specialist to make sure that the silent partner in your wealth management plan, that's the IRS, gets paid as little as possible. This is tax mitigation, not tax avoidance.
dodging.
And also through the use of leverage, right? Are you using it correctly? Are you getting the lowest borrowing costs? Are we setting you up with the structures to get the highest rate of return based on the amount of risk that we want to take on? And this is incredibly important. We'll get to that in a minute. The next piece is going to be wealth transfer. So this is making sure that when you're gone, your assets will go where you want them to go with the least amount of legal fees, time delays, headaches, hassles, and estate taxes.
That's a huge one.
Huge. Yeah, especially if you are a homeowner and you have children. The next piece is going to be wealth protection. So this is making sure that the assets you have put away can't be unfairly taken through disability, divorce, litigation, or death. So this is working with your estate planning attorney, as well as your property and casualty and your life insurance specialist. And then the last piece is going to be charitable giving. If you are putting dollars out into the world, making sure that you're maximizing the impact that you have on those charities, as well as getting the biggest tax benefit. And then the last piece is the relationship management. So I don't know how other people do it, but we do about a 90-minute guided interview of about 65 questions. It's basically a skinny down financial personality test. So it's what's important to you, who's important to you, how do you synthesize information, right? Because our job is not to tell you what to do, right? Most of the people that I deal with are incredibly successful. They've already decided what they're going to do before they come into my office. Hey, I'm going to buy this 3 flat, or hey, I want to invest in this company, right? It's my job to give them context around those decisions. Okay, if you do this, this is how it's going to affect your estate plan. This is how it affects your investment portfolio. Here's all the different ways that we can structure it. And then ultimately, they're going to decide what's right for them. And then the last piece on that is our professional network. So obviously I've been in Chicago in the professional world for the last 25 years. So we know all of the best estate planning attorneys, all of the best accountants, business valuation experts, property and casualty, whatever it is that you need. So here's a situation that happens like with Jason all the time, right? Jason has a client, they've upgraded their house a couple times. Now they want to start getting into owning rental real estate, right? So Jay will find them a property that they want to invest in, right? And then they call me and I'm like, well, we're going to need an attorney to draft up the leasing agreements. You're going to need special property and casualty insurance. You're also going to need a real estate attorney to help you with the transaction through the sale. Kind of all those different pieces that they need to pull together were the first point of contact, so you don't really have to go out and try and assemble a team yourself.
Yeah, and I think everyone knows each other on that team, knows their strengths, and can help each other maximize what that client's looking to do, which I think is huge. I think what Andy just went over is the fact that it's really not about buying Microsoft or selling Apple, this. That's like, to me, because Andy handles my money and my estate, to me, it's the stock buying is 1/100th of everything. It's the whole other gamut. Things that you never think of, but you shouldn't. People like, there's so much that people don't understand that think they do. And all of a sudden, knock on wood, someone passes or something happens. And all of a sudden you have all this tax burden. You have this. And it's like, oh, well, you could have done X, Y, Z. It's too late when it's too late.
Yep.
Like, that is the problem that people make. You need to be in front of this from the start, dealing with Andy from the beginning so that everything is done. Like, a lot of people don't understand. Hey, listen, you have 4 or 5 mortgages are out there. Are you properly insured? So when you die, this insurance pays your mortgages and your partner is receiving the benefit of these rents, and they don't have to take on the burden of these mortgages. I mean, as simple as that is, you don't think about that. You think about that, and that's what your job is. And I think that's incredibly important for people to understand, that the minute you understand that you don't understand, things will be better for you.
Right.
That's an old Greek thing.
Yeah.
The minute you realize you're stupid, you're really smart.
That's why I don't buy investment real estate anymore.
Yeah. To jump to that second, let's talk about, as you have your pillars, but to jump into it, I just got a great job in Chicago. I'm in my mid-20s. I just signed a deal and I'm making $100,000, $150,000, and I'm employed. What would you tell that person coming in? Hey, these are the first things that we need to set up, because you can't do everything at once.
Yeah.
Let's take a step first.
Okay. So you're 20 years old. You just got the first job. Are you married?
Single.
Okay, so you're single. So there's not a whole lot that you really need to do at that point, but there are some low-hanging fruit that you definitely want to go after, right? So generally your employer is going to have a 401k plan, right? You can defer up to $22,000 into that, and that's all pre-tax money. So in that scenario, you're making $100,000. You can defer $22,000 into the 401k. That all goes in pre-tax, grows tax-free the entire time it's in there until you pull it out in retirement. And then you're only paying taxes on $78,000. So you have reduced your overall tax bill by north of 20% just for that given year.
And that money's still there for you.
The money's still there for you. And, one of the pushbacks that I get from younger clients is, well, but what if I need to access that? In another 3 years, I may buy a home. Now, under most of those corporate plans and under the ERISA rules, you can borrow up to 50% or $50,000 against that for the purchase of a new home. So you can put that money in tax-free, and then you can borrow against it. You'll have to pay interest on it, but you're paying the interest back to yourself in the 401k. So you still got liquidity there for a big purchase.
So when you pay the interest goes straight back into it, like it multiplies, it adds to the 401k?
So what happens is it has to be paid back over 5 years, right? And so they'll amortize the loan over 5 years. You can pay it back faster than that. And so every month you'll be paying back a portion of principal, and you'll also be paying back interest. But the interest you're actually paying to yourself on those assets because the money's come out, so it's not actually growing. So you'll have to put more money back in than what you took out.
But it gets you back to where you were.
Well, yeah, and you're paying the interest effectively to yourself. So
that's awesome.
Yeah.
Okay. So how about?
And then the other big thing that a lot of people don't do is they miss the box when they do open enrollment or they sign up for the new job for long-term disability. So most companies will replace 65% of your income, and this is and when you get paid a disability income, it's tax-free, right? So they'll replace 65% of your earnings if something happens to you so that you can't go back to work, right, for an indefinite period of time. For instance, we had a dentist that we took on as clients 15, 20 years ago, and so when he was, I want to say 51, he cut off about that much of his index finger performing a surgery. The insurance company decided that he was disabled for his chosen profession, and so he got $22,000 tax-free every month for the next 23 years.
So if I take off a toe and I can't walk because I have disability.
I mean, I wouldn't recommend insurance fraud, but
I would take it off.
Oh, okay. I don't know if it's self-inflicted. I don't know how that works.
Oh, okay. Can you drive over my toe?
Yeah. And then so
disability insurance. Now, do you want to add to that so it's to 100%, or you're saying your employer usually gives you that 60%?
Well, no. So you'll have to pay for it.
Okay.
Right. So they'll have short-term disability that the employer usually
because you hooked me up with disability insurance. Another thing I never thought of.
Well, you're self-employed.
I'm self-employed.
Right.
I know, but if someone like those are other things that you provide, like, hey, listen, you need this, you need this, you need this.
Correct. Yeah. So we'll come in and we'll do that full suite of things. I think let's jump into like the actual wealth enhancement, and then we'll kind of roll down through them.
Perfect.
So on the wealth enhancement side, we just kind of went over the 401k, and that's where your first dollar should go on a tax basis, right?
Okay.
And then once you get beyond that, there are different things that you can do to mitigate your taxes if you're not self-employed. So the biggest one is the mortgage interest deduction. So under the current tax laws, the first $750,000 of mortgage that you have on your primary residence, you can deduct the interest that you pay every year from your taxes. So that will reduce your adjusted gross income the same way that contributions to your 401k will. And then in the city of Chicago, it's hard to not have $10,000 in property taxes. And so you can also deduct up to $10,000 in property taxes from your adjusted gross income as well. So that's probably like the biggest tax savings that you can get if you're a high W-2 earner.
Yeah, I mean, if you make let's say you make $125,000 and you buy a $600,000 condo, when it's all said and done, your taxable income is probably down to $65,000. If you do the
If you're
insurance,
maxing out your
yeah,
401k
max the
and you're
401k
getting
and
the
you
salt,
own, and your taxes.
probably lower than that. Yeah. It's a huge savings.
Yeah. And yeah, I mean, so like if you're saving $60,000-$70,000 in taxes that you can be taxed on, and you're 30%, you're talking about 21 grand you're not giving to the government.
Absolutely.
And that 21 grand is basically your 401k. So the government, you're basically getting the 401k for free.
Correct.
This is what people don't understand.
Well, yeah, and so like everybody hates on the IRS, right? I'm in that camp, right? But like the way that we design the laws in this country, right? Whether they're tax laws or whatever laws, some of them are designed to get some sort of societal or behavioral outcome, right? And so as we've moved away from the defined benefit pension schemes and the public pensions and things like that.
Schemes.
Right.
Go on.
So as we've moved away from those, they have written the tax code to incentivize people to save for their retirement. So it all kind of works hand in glove to really benefit you if you're putting that stuff away.
Yeah, I mean, that's incredible thinking about a 125 down to 60 or whatever.
And then on the other piece on the wealth enhancement side is really about how you use leverage, right? So if you're a first-time home buyer, you can get away with as little as 3.5% down or 5% down, but you're probably going to get hit with PMI and some things like that. And if that's your only way to go, then
it's there for you.
You can absolutely do that. But if you have some assets, or you have parents who have some assets, you have some other opportunities that are open to you, right? So
talk about that, because you told me about parents having assets and being able, like,
yeah,
the mortgage is crazy.
Yeah,
the discounts.
So most of the larger banks, right, especially if you're working with a wealth manager inside of one of those banks, will have a tiered pricing mechanism for their mortgages, right? So if you're Joe Schmo that comes in off of the street, a mortgage may be 6%. If you have $1 million worth of firm, it may be 5.5%. If you have $5 million worth of firm, it may be 5%, right? Which is a significant savings on a 30-year mortgage,
huge.
Right? A lot of the banks will also run what's called a next gen program, right? So if maybe you don't have a lot of assets put away, but you know that your parents have sizable accounts at a big firm, you can talk to the wealth manager there, right? And it's possible that you can get next gen pricing, so you can avail yourself of your parents' pricing. And then there are some
would the deed, would the loan still be in the child's name?
Yeah,
so they can work on that.
Yeah,
the
parents have nothing tied.
They're just
to
pledging.
That. But they're not even pledging.
Oh, okay.
They're just drafting off of their parents, right? So the way that we built our business, which was probably 10 or 15 years ahead of the industry, was once we get into the family, then we blast up and down and out the family tree, right? So it's like your family, right? We have the parents, we have the grandparents, the aunts, the uncles, the kids, the grandkids, all of that. Well, all the rest of the industry is caught up to the idea that you've got all of these millennials and Gen Xers that are just now starting to come into their own, right? And they've got E-Trade accounts, or they've got Robinhood accounts or whatever. And so they're starting to create these types of programs to try and bring them in-house with the rest of the family. And there's a lot of benefits to being attached to a larger household if that's a possibility for you.
Okay.
Other ways that you can draft off of your parents. A lot of parents want to give their kids money for the down payment, which is definitely a way to go. The problem is that it creates some gift tax issues. And reduces their lifetime exemption for estate taxes. Another way that they can do that, or a lot of times they can pledge their assets to the loan, right? Okay. So let's say they're buying $1 million home, just to make the math easy. It's a $200,000 down payment, but the kids only want to put $100,000 down. The parents can pledge $100,000 of their assets at firm XYZ to that mortgage. Now it'll be a $900,000 mortgage, but it's priced like it's an 80-20 mortgage.
It's an 80-20.
So there's no PMI or a second mortgage or anything like that.
Are they paying anything to? I mean, are they paying anything on that other $100,000, or just?
So the parents aren't paying anything on it. Now they have made themselves liable for $100,000 of that, right? So that can be an issue. Another option that you could have in that scenario. So let's say that you're a little bit older than our initial example, right? And you've got $500,000 of Google shares, and your cost basis on that is effectively zero, right? And you don't want to.
You've just been accruing shares as you work there,
and you don't want to sell those shares in order to and realize a taxable gain that you have to pay taxes on, right? And then put that money into the house, right? Because theoretically, and I know you would disagree with this, but theoretically, stocks should appreciate faster than housing. So you're kind of getting double whammied, right? Because you're moving from a faster appreciating asset into a slower appreciating asset, and you're paying the taxes. So what you can do is, if you don't want to put the 20% down, but you've got, let's say, $400,000 worth of stock, you could do what's called a securities-based loan, where basically you would borrow the money against the stock from the bank and then put that into the property as the down payment and get your 80/20 loan. There's no taxable event. Now, this is a way that you'd want to do it if you had decent income and you thought that you could pay back that $200,000 over the next 2 to 3 years, because you're going to be on a variable rate loan.
Okay.
Another option that you have, same scenario as that one, is that you can actually pledge those assets to the property, and then you could take out financing sometimes up to 100%, right? But still get a conforming conventional loan, or I forget when it's non-conforming, but it's still an 80/20.
Okay. Yeah. I mean, it's
it's
just a jumbo.
Yeah. So those are different ways that you can kind of do that. Another interesting thing that we do with the securities-based lending. So if you're a relatively larger client, right, and you've got a decent sized securities-based loan with us, and we do this all the time with our mutual clients. So the housing market's incredibly competitive right now, right?
Yeah.
In the last 3 years, it's been really competitive, and it's pretty much cash is king. So all cash offers are the way that most of the deals get done. So let's say that you have a $1.5 million stock portfolio at one of XYZ bank, and you have a line of credit set up against that for $1 million. Let's say that they're working with you to buy a 3-flat, right, or a single family home or whatever, that's $900,000. Well, we can wire that money off of the credit line directly to the close. So you can do an all cash offer, 10-day close or instant close, depending on however, as fast as you can go through the work of doing it, and do it all cash. And then as long as you're using a securities-based loan like that, you can do what's called a technical refi within 180 days. Generally.
That's what I was wondering. So can you refi out of that?
Yeah. So normally if you bought with cash, right? Like, so if you wrote them a check out of your bank account and then you wanted to put traditional financing on it, you would have to do what's called a cash out refi.
Yes.
Cash out refis are generally capped out at 65 to 70% loan to value. It varies greatly on the bank. And usually you're taking a 0.5 to a 1 point increase on the rate for those cash out refis. Using the securities-based line of credit, it's what's called a tech refi. So you can't shop the rate out to a bunch of different banks, but the bank generally that provides the SBL to you will do the technical refi. So you can go into an 80/20 loan at the same rates that you would on a purchase, as long as you do that within 180 days of.
That gives you a lot of power.
Borrowing.
That gives you a lot of price power too.
It's massive. Like, it's probably one of the for the folks that we work with that buy a lot of real estate. I mean, this is probably the most used tool in our toolbox.
So think about this. When you think of like a wealth advisor, you normally don't think about what we just went over, but you're talking about 15 minutes of tax savings, knowing how to buy stuff, leveraging, using your own money to create more wealth, and we haven't even gotten to the stock. So that's what I'm telling people, is that there's so much more to what you do that people don't understand how. And I think people are always like, oh, what about the fees? What about this? What about this? And listen, if you pay somebody smart to do what they know what to do, you're going to make 5-fold on whatever. Like, you can go around and shop for a house in yourself. The simple fact of the matter is, I'm going to get it for you cheaper. And I'm probably going to tell you where to buy a house that you're going to make more money on. Like, you can't be short-sighted on the fact that you need to have somebody like you that's going to show you how to really multiply And we haven't even gotten into
Yeah,
insurances.
And just to let me dovetail off that for
Sure.
just a second, right? So I think most people think that you hire a person like me to get them a better return than the market. Like I think that you could value it that way. I don't think it's the correct way to value it.
That's not
right?
That's not your best value.
So
that's not your best asset.
So the owner of your company, Warren Buffett, right, is, let's just say he's the greatest investor of all time.
Okay.
Or one of the best, right?
Yeah.
But his returns above and beyond the S&P 500 are only like 100 basis points a year more.
Yeah.
Right? Give or take, right? So if you have a $500,000 portfolio, like if I'm the best in the world at managing money, I'm going to make you an extra $5,000 a year. Like that's not going to move the needle really, right?
Yeah.
So like you want somebody taking care of it so you don't do something stupid and to get you good risk adjusted returns. But the real value you're getting, or what I think the real value that we give to most of our clients is showing, like, if you own your own business, most business owners, that's a 30% IRR on every dollar that they invest back into that business, right? So whatever money that they're giving to me is capital they can't deploy back into their business. Or if we can help them, create an investment portfolio of real estate, or help them leapfrog through their jobs through introductions that we can make and things like that. Like most of what we spend time on our clients with, and not to say that we're not good at investments, because we're great at it, but like what we spend most of the time in is trying out to figure out how to get them to increase their wealth, not just on balance sheet, but out in the world as well, because generally that's a much more significant return on investment than what you're going to get in public or private markets.
Yeah, and I think that's where people fail to understand.
Yeah, well, I think that a lot of people know it, but most of their experiences have been with people, or what we call technicians, that really only focus on the markets, right? There's a lot of people saying that they're financial planners or that they're wealth managers or whatever, but in reality, they're stockbrokers. And if you're paying for a stockbroker, then you're definitely overpaying.
So let's talk about, we talked about this wealth management. Let's talk about people that are in their late 30s and 40s and have a kids. What are a couple strategies that you would be like, hey, do you have this? We have to do this right now.
Okay, so
your 401k is good, or you've got a SEP going as you're self-employed. You're going, all of a sudden the kids start popping up. They come and meet with you. Hey, we've got $1.5 million or $2 million in assets. We want you to take us to the next level.
Yep.
And how do we protect ourselves?
Okay. So on the wealth transfer side, we'll kind of run through the life cycle of some of the different things that I think are important, but this is in no way going to be exhaustive. So first off, you're married, there's no kids, but you've just bought your first house. At a bare minimum, you're going to want to have term insurance on about a 20-year term.
Okay.
On each the husband and the wife, or the husband and the husband, whatever it is, for the remaining balance on the mortgage, right? So if we have two people, they're married, they probably bought as much house as they could, right? So they need both their incomes in order to make the mortgage payment. So you want to make sure that we can pay the mortgage off in the event that one of them passes.
So if somebody passes away, just so everyone's clear of this, you've got money that comes in, pays off the mortgage, and the person that is left on this earth doesn't have that burden on them.
Yep.
It's just huge.
And then there's a couple things that you want to do when you purchase the house.
People don't do that. They need.
It's huge.
It's huge. Okay.
And then the next piece that you want to do is when you buy the property, or if you've already bought the property, you're going to want to use an attorney to come back and fix that. So there are different ways that you can hold title on a property, right? So a trust can hold title to the property. Individuals can do it. You can do it joint tenants with rights of survivorship. You can do joint tenants in common. They all have different things. But if you're a married couple, then you want to be owning your piece of real estate in what's called tenants by the entirety. Okay, so tenants by the entirety. Okay, backing it up. So the IRS tax code allows for each person to get a $250,000 cap gains credit whenever they sell their primary residence. They can do it once every 5 years as long as they lived in it 2 of the last 5 years.
So that's the profit, people, like that you make on the place.
So if you're a married couple, you buy a house for $500,000, you turn around and you sell that house for $1 million. 4 years later, you pay no capital gains tax. You sell it for $1.1 million, you're going to pay capital gains on the $100,000 of profit. Okay, so you've each got this $250,000 credit, but what happens in that same scenario, and the husband dies, right? So if it was owned in joint tenants with rights of survivorship or joint tenants in common, or they would get a step up on their half of the house, right? But that would create about $125,000 in capital gains that the wife would have to pay if she sold the house for $1 million.
Okay.
Whereas if you own it by tenants by the entirety, then I'm sorry, with joint tenants, you don't get a step up on the house. With tenants by the entirety, the husband's half gets a step up at his death to half of the fair market value, and then the wife has the $250,000 credit. So it's incredibly tax advantageous if something happens to one of them to have it titled in tenants by the entirety.
Okay.
And then the next thing that we recommend that you do when you're purchasing the house is that you can do tenants by the entirety, but then you can also record it with what's called a transfer on death instrument. Right. And if you do it at the time that you title the house, it usually doesn't cost much to do that. But so it's in the event that both of you pass away at the same time, the house can pass to a beneficiary, like an IRA account or something like that, without the house having to go through probate. So as long as the deed has that recorded with it, let's say that you have adult children, right?
Okay.
And you don't have enough money to have a very convoluted estate plan, right? But mom and dad have the house. They both pass away. They have one son, Johnny. So now normally the house would have to go to probate, and you could sell it in probate, but Johnny can't get access to that money for 6 months after probate is opened, right? All he can use that money for is to pay the bills of the estate. So if it takes 2 or 3 months to get probate opened, and then 6 months from that date, it could take 9 months before he gets access to the money. Whereas with the transfer on death instrument, the ownership of the house changes immediately once he presents the death certificate at the county courthouse, and they re-record the deed in his name, and he can sell and do whatever he wants. It doesn't get him out of being subject to any of the debts of his parents' estate, but it makes it a lot cleaner and a lot easier.
He would still have to pay. He wouldn't get any exemptions on the $500,000, right? He wouldn't get a 200.
Well, so it doesn't matter to him in that case. So because the value of the house would be stepped up to the fair market value at the date of death.
Oh, okay.
So the house is worth $1 million now. He gets it for $1 million. He sells it, right? Whatever he sells it for within 6 months of the date of death, that's going to be the fair market value.
Oh, got you.
Right. And so that money all comes to him tax free.
I got you. And there's no estate tax on the transfer of the property?
Well, so we're talking income tax. Estate tax is a whole other issue.
Okay. Forget it then. Okay.
So that's for a married couple. They own a piece of real estate. And then they have the kid.
Yeah.
Right. And now that we've had the kid, now you need a lot more. So first off, before you have the kid, and you want to do all of your estate planning while you're pregnant, it can seem like tempting fate, but here's the thing I would tell you as a parent, and you would probably agree with this. Once that kid comes, the first one comes, like, you're not sitting down with an attorney or anybody else for 6 months to a year, right? So highly recommend that you do it once you either are pregnant or are trying to get pregnant. And so the first document that you're going to need is a will. Now, everybody thinks that a will is for transferring your assets at death. You can use that, but a will is only valid in probate court, which if you've got a good guy like me, the whole goal is to avoid probate court. But the will is incredibly important once you have a child, because a will is the only legal document that you can name guardianship for a minor child in.
Yep.
Right? So you've got the will, and you've got to say, okay, well, little Johnny's going to go live with my sister Sarah, or, my brother Devin, or whatever that is. You can also name in that document who's going to be the custodian for the assets. So if it ends up in like an UTMA account, because the children are minors and we haven't done any other estate planning, you may not necessarily want the person taking care of the child to be the same person that's taking care of the money for the child.
Okay.
Right? Some families, there's somebody who's very loving and would be like the great person to be their parent, but they're terrible with money. And they, and there's another sibling that's really good with money, and that's who you'd want managing that piece of it. And then you're going to want to significantly up your life insurance. Permanent life insurance,
Yeah. What's your feeling on whole versus the term?
Yeah, so permanent life insurance is we call them rich men's Ross.
Okay.
Rich men's Ross IRAs. So you can put money in there after tax, you can grow it tax deferred, and you can pull it out tax free. The issue is that 90% of the people who use that type of structure, I don't think it probably is appropriate for, right? Generally, where we're using that, you've got somebody who's a really high earner that's maxed out their 401k. They've already got significant taxable investment accounts that they can use for leverage, right? And they're looking for another place where they can get some tax savings, and they need a significant chunk of permanent life insurance because they're going to have an estate tax issue when they pass away.
Okay.
So like, there's no 100% of the time that's the answer, but for most people, like term insurance for estate planning purposes, as far as income replacement, or if we're taking care of the children or whatever, term is a very cheap and effective way to go. For most people in their 30s, every $1 million is going to cost you $800 to $1,000 a year. So it's relatively cheap. So once you have the kid, you want to get the will, and then you also want to do the insurance. For the women, you want to do the insurance while they're pregnant.
Okay.
If you can, right? Because all of the hormones are juicing all of their antibodies and everything. So you're going to get one of the lowest underwriting.
Oh,
like you're going to get a preferred underwriting reading generally during that. So generally, if you're having the child, you're going to want $1 million to $2 million in term plus whatever the mortgage is on it.
Okay.
So, for instance, let's just say that you have a gentleman who's making $200,000 a year, and his spouse is a homemaker, right? Okay. And you're like, well, she doesn't make any money. I don't know that she really needs $1 million or $2 million in life insurance on her. Well, the thing is that you're now a single dad, right, with a small child. So there's going to be childcare costs that you're going to have to deal with, right? So, and that's going to run you $50,000 a year, right? Like an early childhood development center on one child is going to be $35,000 a year in the city of Chicago, and then you're going to need aftercare and babysitters and all of those things. Yeah. So, and then generally anywhere from like 2 times to 5 times coverage on whatever the primary breadwinner has an income.
When do you start saving for school?
So saving for school, I generally recommend that we set up the 529 within a few weeks of the child being born. Okay. Right? Because if in most instances you're gonna start getting checks, right? From relatives and things like that. Yeah, it's a good place to dump it. So you can dump that money into the 529s, and you can generally get a pretty good nest egg going right off of the bat.
So if you're in your mid-30s, you start to have kids, you want to make sure you have the proper insurance.
Yep.
You want to make sure you start your nest egg for your children's schooling. And then you also want to have your disability insurance that we picked up in your 20s.
Yep.
Do you re-look at that, or is that just kind of, mine always just adjusts itself?
Yeah. So if you're self-employed, we may take it out to the market and shop it every 3 to 5 years. But if you're a W-2'd employee, like it's going to be kind of an off-the-shelf package that you'll sign up for in open enrollment every year. So, and then you need the will to name guardianship.
The will, yeah, the will's huge.
And then you've got to make a decision about whether or not you want to spend some additional money at that point. Okay. So like I said, our whole goal is to avoid probate, and you can do what's called a poor man's estate plan, right? So the life insurance is going to have named beneficiaries, right? So you and I are married. I have insurance on you. You have insurance on me. I'm the beneficiary if you die. You're the beneficiary if I die.
Yes.
Okay. Your 401ks, those are going to have named beneficiaries. You can do a transfer on death on the taxable accounts. You can do a transfer on death instrument on the home, right? So as long as you don't have kids, you can get away with all of that if you didn't want to spend the money. But once the kids come into play, I highly recommend that you look at using revocable living trusts on the husband and the wife. So a revocable living trust is a document that your attorney is going to draft. And what you would do is you would title everything but the house and the 401ks so that the trust had ownership of it. Now, this is not an irrevocable trust. So the Jason Stratton Rev Trust would be tied to Jason's social security number. So while he's alive, it's a doppelganger for him as he goes through life, right?
Okay.
You can move money into it and out of it like you would any normal bank account, but at death, it snaps shut into an irrevocable trust for the benefit of your wife or your children or whoever you want to be. The reason why we generally recommend the trust is that, so let's say that you have the worst case scenario where the husband and the wife both pass away at the same time and you've got minor children.
Okay.
So under that scenario,
With the trust.
without the trust.
Without the trust.
So in that scenario, all of the assets are going to go into what's called a uniform trust for minors account, right? So you and I, we both pass away. We've got little Johnny who's 4 years old. We've got $5 million that's going to drop into this uniform trust for minors account.
Oh, Johnny's happy.
Yeah, that Sophia is going to manage until he hits the age of maturity, which is going to be 18 or 21, depending on the state that he lives in. Now, if Johnny is like you at 18 and he gets the $5 million, he's fine.
Dead. He's dead.
Right. Okay. Exactly. So,
No, I set my will up where it's like spurts of money.
well, so you've got the Rev Trust that we set up
Yeah.
for you. And so what I generally recommend is if you've got some money that's very likely to outlive the child getting the majority, right? Like if you only have $1 million and your kid is going to live with somebody else, the bulk of those assets are going to get run through by the time that the kid hits the age of majority, right? But if if you've managed to put away, north of $1 million, I recommend at least looking through a Rev Trust. So like the way that our Rev Trust is set up, both Devin and I. So everything dumps in there, and then it can be used for the health, education, maintenance, and support during while Emily is a minor, and then beyond that as well, right? You're the trustee on that trust. But once she hits the age of majority, she doesn't have the right to actually access that money. So you're still the acting trustee. At age 30, you are still the trustee, but at your discretion. So you can make disbursements after age 25 to her if she gives you a business plan. Right. But at age 30, you can add her as a co-trustee, and there are limits around what she can do as far as taking money out or things like that. And then at age 40, in your discretion, you can remove yourself as trustee
And say, listen,
and
she's
she
done.
can be the sole trustee. But the problem is that my daughter is 7 years old, right?
You don't know.
I don't know what she's going to be like at 20. I don't know what she's going to be like at 25. I don't know what she's going to be like at 30, right? So, but I trust you, and I trust your judgment.
So is the revocable trust, is that basically like in a high level, it's basically setting up everything so when people pass, or is that the will that you're talking about?
No, so the will just deals with the passing of the assets.
Okay.
And that's only valid in probate court, which is a convoluted process. And as somebody who's buried both of their parents, I can tell you that like every time you have to deal with somebody's estate after they're gone, it's like the grieving process is like a cut that happens to you, right? And then it scabs over and then it heals. Whenever you've got to constantly come back, it's like just ripping the scab off over and over and over again. The trust really allows you to control the assets from beyond the grave.
Okay.
Right? So that you can make sure.
I just want to make sure people understand the difference.
Yeah. And especially if you've got a pretty good chunk of money, right? In addition to passing on the money, there may be values that you want to pass on to your kids as well, right? So you could put stipulations in there about they have to have a job or they have to finish college or like whatever it is. Like if you want behaviors that you want to encourage or things like that, that would be the place that you could build those things in.
Yeah. I know I have my trust. I've got the voice from the grave. Basically, I've got someone on my side in case Nikki gets remarried. He's my voice.
Oh, that's a great point. Yeah.
So I have that.
Yeah. So that's a trust.
And Nikki has hers.
Yep. It's a trust protector, right?
Yeah.
So, So generally you use,
I don't know who the hell she's gonna marry.
well, generally you'll use
And
that.
I don't like him already.
Yeah, generally you'll use that early on in a marriage,
Okay.
right? If you've got significant assets and young children, and you're worried that the surviving spouse might marry an idiot who just wants to go after them, Pablo the pool boy,
Yeah.
right? Like he's not in it.
Pablo's
for Nikki
not
or the
getting my
kids.
money.
Yeah.
Damn it.
You know, and something like that, because it's a revocable living trust. Let's just say that you get into your late 40s, right, and you've been through the war with your spouse, right, and you're at a point now where you're just like, I don't care anymore what she does with the money if something happens to me, right? So my wife and I just went through this like a year or two ago, and we just I removed it out of my trust.
Oh, mine will stay in.
Well, it's a very personal thing. Yeah.
I need somebody to have my back, man, when I'm 6 feet under.
Yeah. And then the nice thing about the Rev Trust is so right now each person has it's either an 11 or $12 million lifetime exemption on the federal estate tax, right? So let's say that you have $22 million between you and your wife collectively. You would want to make sure that you had $11 million in your trust and $11 million in her trust. You die first, your trust becomes its own entity and is not pulled into her estate for estate tax purposes.
I got you.
So if her 12 million is now 15 when she passes away, there would only be an estate tax due on the remaining $3 million. You know, and then we can get really fancy. So we can do qualified personal residence trust. We can do grantor retained annuity trust. Like there are all different ways using the estate tax code and the gift tax code where we can start to reduce a taxable estate. But I think that's probably a little.
That's too much.
Yeah, it's too much.
On the gift, hold 1 second though. It's on the gifting thing, to a person who's in their 20s or 30s and their parents are getting older. You know, I always hear about how I can give one-time gift every year to my siblings and I can take that off my taxes. Can you just like hit on that for 2 seconds?
Yeah, so it doesn't come off your taxes.
Okay, hit on that.
So you have what's called the annual exclusion gift, right?
Okay.
Which is currently $17,000. So you can give any person, as many people as you want, $17,000, and you don't have to file a gift tax return. You don't have to report it, anything like that. Like you can do that. So you can give Lee $17,000. You can give Will $17,000. You can give James $17,000. Now,
does it benefit me at all?
Well, it depends, right?
Because my mom used to say, "Here's this money I'm going to give you because I can give this gift and not have this."
Yeah.
This or this.
Well, so the issue is that whether or not they have an estate tax issue, right? So, for instance, let's play this out 40 years into the future.
Okay.
Right. You and Nikki have an estate that's either going to be taxed at the federal level or the state level, because the exemption in Illinois is $4 million. Everything above $4 million gets taxed at 16%.
Okay.
The key takeaway there is don't die in Illinois.
Yeah, I won't.
But so if you're at that point, right, and you have kids and you have grandkids at that point, then you can give them each $17,000. Now Nikki can give each of them $17,000 as well. However, you will have to file a gift tax return if you both do it, stating that you're splitting the $34,000, $17,000 between each of you.
Okay.
Anything that you give above and beyond the annual exclusion gift, so there's no actual tax that's paid on a gift tax, but you've got a bucket that's gift tax and you've got a bucket that's your estate tax exemption. So if you give money away, so let's say that you gave $1 million away, right?
Okay.
And you'd already given the $17,000. If you gave that $1 million away, you would have to file a gift tax return and your exemption of $12 million would drop to $11 million. So now you'd only have $11 million of exemption left.
Okay. So there is really no reason to give your kids money every year. There's no benefit to the parent.
Yeah, normally you would only be doing it if, like, a lot of people, we will start gifting money away in their 50s, maybe 60s, definitely in their 70s if there's an estate tax issue.
Okay.
But on that same note though, if you have grandparents that really want to make a big impact as far as college planning goes, or you have parents that want to do that, they can gift the $17,000 annual exclusion amount. They can do 5 years all at once if they want.
Okay.
So 17,000 times 5 is $85,000. And if you have a husband and wife, you could do a total of $170,000.
So you're giving this money away when you've got it makes sense when you have a substantial amount of wealth. Not when you're Tom, Dick, and Harry.
Not when you're Tom, Dick, and Harry.
Okay,
yeah.
Forget it.
The one thing, though, that I would recommend, since we've touched on the 529, so I'll give a quick primer on how a 529 works.
Okay.
It's basically a Roth IRA for education purposes. So you put money in after tax, it grows tax-free while it's in there, and as long as you pull it out for any type of service that is considered education expense, then all the growth and the principal come out tax-free. Okay, so most people.
So when you just 1 second. So when you add the money to the 521, will it lower your taxable income?
No, it's after tax. Like
okay,
a Roth
it's after
IRA.
tax. Okay.
Yeah. So, but if you put 10,000,
So you just don't pay the taxes on the gains.
yeah. So if you put $10,000 in it today, you've paid the taxes on the $10,000. It grows to $100,000, and you pull it out and pay for the first 2 years of school. You pay no taxes.
Gotcha.
On that.
Gotcha.
But here's the thing that I think is really important, and it depends on how much you trust your parents or you trust your grandparents. But so most people want to set up a 529 that they own, right? So in our scenario, you and I, one of us would set up a 529 for little Johnny,
Okay.
right? So the issue with doing it that way is that if Johnny or one of his parents owns the 529, when he goes to fill out the FAFSA form, do they still call it the FAFSA form?
I don't know what the hell that is.
So that's the form for financial aid.
Okay. I don't know.
Right. So if you're looking to get a grant
Okay.
or you're looking to get tuition assistance or anything like that, a 529 owned by the child or owned by either of the parents will be includable on that FAFSA form along with their income, their assets, and all of that stuff. A 529 owned by the grandparents or our parents, so the grandparents of Johnny, our parents, owned by them, will not be includable on the FAFSA form. So it's much better for the parents or for.
So if my mom owned the 529 that was payable to Lee or Will,
correct.
So it's not in their name, or it's just their.
Well, so there's two pieces to a 529. There's the owner.
Okay.
And then there's the beneficiary.
Okay.
So the beneficiary would be Will or James or Lee.
So it's the kids, but the owner is.
But the owner could either be you or Nikki or
my mom.
Yeah. So if you know that there's no way that your kids are going to qualify for financial aid, right? Like if you're a high income earner, then
you can hide that 529. Or
well,
then
it doesn't really matter, right? Because they're not right.
I got you saying.
If you're upper middle class, like your kid's not going to qualify for
so
financial
then there's no
aid.
reason to do it.
But if you don't have a lot of money and the kids are coming, right, and you're going to set up those 529s, then you would want to have them set up in the grandparents' name.
Oh, okay. There's a trick.
Yeah, and they can always gift it down.
Yeah. Okay. All right, we got to wrap up a little bit. Anything that we didn't touch that we should touch the last 5 minutes?
So the biggest piece is probably,
biggest piece.
Well, the biggest piece for most people, and I think this is the biggest trapdoor. So on the wealth protection side, we've covered the life insurance, right? And we've covered some of the legal documents, but the big piece that we see most of our clients missing is on the property and casualty. So this is your home, your auto, and your personal umbrella liability. Okay, so
mind you, Andy sets all this up for you. So that's just letting people understand, like, part of this process is not only everything's gone over, but when it's time for me to get insurance, this and this, Andy says, I have the person for you, this and this. It's seamless. It's easy. You're getting, you're probably getting a discounted rate because Andy has some leverage because of all the clients he has. And on top of it, it's all handled there. And then everyone knows there's a central system, which is Andy that's handling that. Go on.
Okay. We don't actually do the property and casualty, but we get the analysis done. Yeah. So we have some preferred
point
partners.
Of contact.
Yeah, and they're
that's
great.
the relationship.
So the biggest piece is, so let's say that you have a homeowner's policy, right? And if the house burns down, then they pay you back for the house, right? Well, one, you want to make sure that you've covered the valuables. If you've got watches, if you've got art, you've got nice cars, like you definitely want to make sure that those are in line. But the biggest piece is what happens if something happens on your property, right? And that's where the personal liability comes in. So let's say that you have a trampoline in the backyard and the kids are playing in it and two of the kids fall off and have some injury, right? And those parents sue you. Well, your general homeowner's policy is only going to have a $300,000 or $500,000 personal liability in it. So you're going to want a personal liability umbrella that covers up to whatever your total net worth is, right? Same instance with the car. Most of them are going to have damages up to $250,000 or $500,000. But if you run into a Bentley, it's going to be a lot more than that. And so, $1 million umbrella liability policy is going to run you like a couple $100 a year.
Yeah,
like,
it's so cheap.
It's so cheap.
Yeah.
And it's like every day we meet with new clients or we'll do a review on existing clients, and like they'll have no umbrella policy, or they'll have $20 million in assets and a $2 million umbrella policy, right? And so the thing about the umbrella policy, this is why it's important, right? So if you get in an accident, right, and they sue you and it runs through whatever the insurance is on the hook for, let's say the $250,000, now you're fighting that, right? You're hiring lawyers, you're going to court, like you're doing all of that, and then you're going to pay for all of that. If you've got a $2 or $3 million umbrella policy on there, now the insurance company is fighting on all of that, right? And their goal is to give as little of that, is to pay out as little of that policy as they possibly can, right? So they've got the best attorneys that are used to fighting this every day. And very rarely, if you have a decent sized umbrella policy, will any settlement go through.
That's
that,
what I've heard.
Unless
I heard if you have a huge policy, they're normally like that.
Unless you're like criminally negligent or something like that, right? Where it's just really above and beyond. But yeah, it's a huge piece, and most people don't really do that.
And that's part of that whole philosophy of you getting somebody in and saying, okay, let's look at everything from start to finish. So all avenues, because wealth management is managing your wealth. If you get sued and you're not properly covered, you've lost your wealth.
Right.
So it has not been managed.
Yes. And then I don't get paid to do the investment.
Yeah.
Right.
I think there's a lot that we covered. We'll definitely cut it up and do little snippets here and there. Yeah. But I think the main thing to understand is that it's, when I talk to people and I say, hey, listen, do you have a wealth manager? This, they're always like, well, no, I do this stock. This. I'm like, it's not about the stocks. It's about setting up your kids, setting up your family, setting up your will, making sure your insurance is correct, making sure that if anything happens to any of your loved ones or yourself, everybody is covered from the rooter to the tutor. And also making sure that everyone else is in line in your family, because people that are older than you, if they pass, we didn't even get into this, there could be taxable income that you can't cover. So like there's a whole, and we won't, it's just too much. But
we only peeled like maybe the first layer of the onion.
Yeah, there's a whole other thing that people don't really get and don't understand that you need to, especially if you're starting to grow your wealth and you're heading in the right direction. So we did. This was a long one. It was good. I want to thank Andy. If anyone wants to reach out to Andy, you can reach out to me. I'm his liaison, and then I'll distribute your information as I feel that it needs to be. Because I'll get some wacky stuff.
Right.
And thanks again. We're over at One Chicago. It is a beautiful place. The backdrop is amazing.
Thank you for talking me into this.
Yeah, it's unreal here. I took a couple of photos of it too. And that's that. Thank you so much. Once again, thanks to Andy Embery and all his designations. And we'll see you soon. Thanks.